How do you know if a stock is expensive or cheap? Sounds simple, right? But it's not just about the stock price. A $10 stock can be overpriced, and a $1,000 stock might actually be undervalued. Let's break it down step by step, using three key indicators: the P/E ratio, the P/B ratio, and earnings per share, or EPS. We'll also talk about what it means to be a shareholder in a company. First up, the P/E ratio, or price to earnings ratio. This is one of the most common metrics investors use. The P/E ratio tells you how much you're paying for $1 of a company's earnings. For example, if a company has a P/E ratio of 20, you're paying $20 for every $1 it earns per year. Now, what's a good P/E ratio? It depends on the industry. Tech companies often have higher P/S, while utility companies might have lower ones. As a general rule, if a company's P/E is significantly higher than its competitors or the market average, it might be overvalued, or investors expect high growth. Let's say Company A and Company B are in the same industry. Company A's stock is trading at $100 and earns $5 per share. That's a P/E of 20. Company B is trading at $80 and earns $10 per share. Its P/E is 8. Based on this, Company B appears cheaper, because you're paying less for each dollar of earnings. Next is the P/B ratio, or price to book ratio. P/B ratio equals market share price divided by book value per share. Then, to get book value per share, we divide that net worth by the number of outstanding shares. The book value of a company represents the value of everything the company owns, its assets, minus what it owes, its liabilities. This is a powerful tool for spotting potentially undervalued or overvalued stocks. In other words, book value is the net worth of the company according to its balance sheet. The P/B ratio compares what the market is willing to pay per share to the actual accounting value of the company's assets per share. A P/B ratio under 1 might indicate that a stock is undervalued, meaning the market is pricing the company lower than the value of its assets. Some industries naturally have lower or higher P/Bs. If a stock has a P/B ratio less than 1, it might look like a bargain, but it can also be a red flag. A P/B ratio under 1 means the market is valuing the company for less than the value of its net assets. In theory, if the company were liquidated today, its parts could be worth more than its stock price. Sounds like a deal, right? But be careful, sometimes there's a reason the market is pricing it that low. It could be due to weak earnings or declining profits, poor future growth prospects, management issues, or even industry-wide problems. If a retail company has a P/B of 0.6, it might mean investors think its real estate is worth more than the stock price. Or that it's struggling, losing customers, and headed for trouble. Now let's talk about earnings per share, or EPS. This is a measure of how much profit the company makes for each share you own. High and growing EPS is a good sign. It means the company is making more money per share. However, don't look at EPS alone. A company could have a high EPS, but if the stock price is way higher than that earning power, it might still be expensive. Now, here's something many new investors overlook. When you buy a stock, you're not just buying a piece of paper, you're buying a piece of the company. That gives you certain rights: right to vote on major company decisions, right to receive dividends, if offered, right to sell your shares, right to company information. You're a part owner. That means if the company does well, you benefit through stock price appreciation or dividends. But if it performs poorly, you share in that downside too. So before investing in any stock, ask yourself, what's the P/E ratio compared to peers? Is the P/B ratio telling me it's undervalued or overvalued? Is the EPS growing consistently year over year? And finally, do I believe in the future of this company? Always compare a stock not just to its past, but also to other companies in the same industry. Ratios give you clues, but don't forget to look at the bigger picture, like the company's growth potential, competitive advantage, and leadership. If you found this video helpful, give it a thumbs up and share it with someone just starting their investing journey. Got questions about specific stocks or ratios? Drop them in the comments below and I'll cover them in a future video. Thanks for watching, and remember, investing isn't about timing the market, it's about time in the market. See you next time.